What if your financial future is at risk because of small money decisions you're making today? A lot of people don't realize that certain habits or choices, even if they seem harmless, can cause major financial damage over time. In fact, the decisions we make about money today can determine how secure we feel about our future. Whether it's delaying savings, buying too much house, or getting stuck in credit card debt, these seemingly small choices can snowball into bigger problems. Stick around to discover the top 8 money decisions that could hurt your future, and more importantly, how to fix them before it's too late. 1. Delaying retirement savings. Have you been putting off saving for retirement? It may seem like you have plenty of time to start later, but delaying your retirement savings can be one of the worst financial decisions you make. The damage of waiting too long is staggering. You miss out on compound interest, which is the magic that allows your money to grow over time. For example, saving $20 a week in your 20s could lead to hundreds of thousands of dollars by the time you retire. But if you wait until your 40s or 50s to start, you're significantly reducing the amount of time your money has to compound. In fact, the longer you wait, the more you'll need to save each month to catch up, making it harder to reach your retirement goals. The fix is simple. Start as early as possible, even with a small amount. Utilize tax-advantaged accounts like a Roth IRA or 401k to make the most of your savings. Automating your contributions ensures consistency and eliminates the temptation to spend that money elsewhere. The earlier you start, the more your retirement fund will grow, helping you enjoy financial freedom when the time comes. 2. Buying too much house. We all dream of owning our perfect home, but buying more house than you can afford can quickly become a financial burden. Spending more than 28 to 30% of your income on a mortgage means you're house poor, leaving little room for savings, investments, or emergencies. While your home may be beautiful, you could be sacrificing long-term financial stability and wealth building. To avoid this, purchase a home based on what you can comfortably afford, not what the bank approves you for. Stick to a budget that allows you to maintain a balance between living comfortably and saving for future goals. It's tempting to buy a bigger house, but living within your means is crucial. By choosing a home within your budget, you ensure financial flexibility and maintain the ability to save, invest, and build wealth over time. 3. Financing depreciating assets, new cars. One of the biggest money mistakes people make is buying new cars that lose value as soon as they leave the lot. A new car typically loses 20% of its value in the first year alone, and when you finance that purchase over 6 or 7 years, you could end up owing more on the car than it's worth. The damage here is that you're essentially paying for an asset that is continuously losing value, while at the same time, you're burdened with high monthly payments. To solve this problem, consider buying reliable used cars instead of financing a new one. A well-maintained used car can still provide great value without the steep depreciation hit. If you must buy a new car, aim to keep it for at least 10 years to maximize its value and avoid being upside down on your loan. Remember, cars are depreciating assets, meaning they lose value over time. It's smarter to save money by purchasing a car that doesn't burden your finances with constant high payments or poor resale value. Stick to what you can afford and make sure your vehicle is a tool for transportation, not a long-term financial drain. 4. Carrying a credit card balance. Carrying a balance on your credit cards is one of the easiest ways to fall into financial trouble. With interest rates often exceeding 20%, credit card debt can quickly spiral out of control, leaving you paying double or triple for basic purchases. The damage here is that you're essentially paying for things you already bought for much more than their original price, just due to the high interest rates. To break this cycle, treat your credit cards like a debit card. Only spend what you can afford to pay off in full each month. Automating your payments is a good strategy to avoid late fees and ensure you're staying on top of your payments. If you already carry a balance, prioritize paying it off by focusing on the credit card with the highest interest rate first. Once that's paid off, move on to the next one. The key is to reduce your overall credit utilization and pay off your balance as quickly as possible. Carrying a credit card balance not only costs you money but also harms your credit score, making it harder to access favorable loan terms in the future. Commit to paying off your credit card balance every month to avoid the unnecessary financial burden. 5. Cashing out a 401k early. When changing jobs or facing financial difficulty, the temptation to cash out your 401k may seem appealing. However, doing so can have significant consequences. The damage here is twofold. You not only face hefty taxes and a 10% penalty, but you also stop the growth of your retirement savings, which can hurt your long-term financial security. The fix is simple. Don't cash out your 401k. Instead, roll over your balance into an IRA or your new employer's plan to keep your retirement savings invested. This way, your money continues to grow tax-deferred, and you avoid penalties. Remember, the purpose of a 401k is to provide for your future, and cashing out early means you're sacrificing that future for short-term needs. While it may feel like an easy solution in the moment, keeping your retirement savings intact is crucial to ensuring financial stability in the future. Consider all your options carefully before making this decision. 6. Not having health or disability insurance. One of the biggest financial risks you can face is not having adequate health or disability insurance. A major illness, accident, or disability can instantly drain your savings or push you into debt if you're not covered. The damage comes when unexpected medical expenses or income loss arise, leaving you financially vulnerable. To protect yourself, ensure you have proper health, life, and disability insurance. If your employer offers affordable disability coverage, take advantage of it. If not, consider a private long-term disability policy. With health insurance, you won't face overwhelming medical bills, and disability insurance will provide income if you're unable to work. By securing these essential protections, you're safeguarding your wealth-building efforts and securing your financial future. 7. Ignoring small, recurring expenses. Small, recurring expenses like subscriptions, apps, or memberships often slip under the radar but can silently drain your finances. These costs, while individually minor, can quickly accumulate and take a significant chunk out of your budget. The damage is that they divert money away from things that could better serve your financial goals, like savings, investments, or debt repayment. The solution is simple: perform a subscription audit every few months. Review all your recurring charges and cancel any you don't need or use anymore. Many banking apps now make tracking subscriptions easy. Start by eliminating subscriptions to streaming services, apps, or gym memberships you've outgrown. By cutting these unnecessary expenses, you'll free up more money for goals that truly matter, helping you improve your financial stability and progress. 8. Co-signing a loan for someone else. Co-signing a loan for someone else may seem like a kind and helpful gesture, but it can have serious consequences. The damage here is that if the person you co-sign for defaults on the loan, you're responsible for the full amount. This can not only harm your credit score, but also put a strain on your finances. To avoid this, think carefully before co-signing any loan. If you do decide to help someone, consider giving a cash gift instead, only if you're comfortable with the possibility that you may never get the money back. It's essential to weigh the risks carefully, as co-signing a loan creates a financial liability that could affect your credit and overall financial security. Always protect your own finances first, and make sure that helping someone else doesn't jeopardize your own financial future. There you have it, 8 money decisions that can hurt your future and the simple fixes to set you on the right path. Financial stress often comes from small choices made today, but with proactive planning, you can avoid these mistakes. Start saving for retirement early, buy within your means, and avoid high-interest debt. Take charge of your finances now to secure a better future. If you found this video helpful, don't forget to like, share, and subscribe. Thanks for watching, and I'll see you in the next one.